Recent reforms have made Europe's banks more stable and resilient. Overall, they had been much better capitalized and ready to withstand economic shocks. We have made great strides towards building a banking union. Yet, for all this progress, there remain areas where our regulatory framework needs to be strengthened and adjusted to reduce risks and support strong banks, lending to companies and households. This is why we are coming forward with 5 pieces of legislation to change the Capital Requirements Regulation, Capital Requirements Directive, Single Resolution Mechanism Regulation, and the Bank Recovery and Resolution Directive, on which there are 2 separate proposals. We are also publishing a communication on the call for evidence and the report on the European Market Infrastructure Regulation. Together, our proposals would bear down on risk, but recognize the importance of maintaining a diverse banking sector in Europe, from small banks serving to local communities to major banks operating across the single market. Today's package would make adjustments to help support a dynamic and competitive banking sector, drawing on call for evidence responses. Because where we can, we want to make our legislation more growth-friendly while sticking to our prudential requirements. Banks operate in global markets. We need global standards for a level playing field and stability in international markets. So, to further strengthen our bank sector's resilience, we want to introduce into EU legislation standards agreed by the Basel Committee and Financial Stability Board. To avoid excessive leverage building up in the financial system, we want to introduce a binding leverage ratio of 3%. Our proposal would add the leverage ratio alongside the risk-based own funds requirement in the Capital Requirements Regulation, and it will act as a backstop to banks' internal model-based capital requirements. To ensure banks finance their long-term loans with stable sources of funding, and can handle periods of market stress better, we are proposing to introduce a net stable funding ratio. To ensure requirements for banks with sizable trading activities are aligned with risk, we are proposing an overhaul of trading book capital requirements. And to tackle risks linked to global and systemically important banks, we are proposing they have a minimum level of total loss absorbing capacity. This will mean they can absorb losses better and be resolved if necessary. The TLAC rule would be incorporated into Europe's existing minimum requirement for own funds and eligible liabilities, or MREL. It would apply to 13 banking groups in the EU. We are also proposing to harmonize the hierarchy of bank creditors, to give investors and resolution authorities more legal certainty, and to allow supervisors to intervene early in case of problems through strengthened and harmonized moratorium powers. We are also working on the proportionality in our regulatory framework. For smaller banks, this package will reduce the reporting burden. It would reduce disclosure and simplify the calculation of capital requirements for trading-related positions, and lighten some remuneration rules for smaller banks. We are proposing to maintain the current SME supporting factor and extend it to all loans to SMEs. To encourage the infrastructure investment Europe needs, our proposal would lower banks' charges for lending to infrastructure projects, providing these are low risks and have predictable cash flows. Today's proposals also support our efforts to create deeper and more liquid capital markets in Europe. By making capital requirements for trading book positions more risk-sensitive, we will make it cheaper to make markets in some high-quality financial instruments, such as simple and transparent securitizations or covered bonds. Today's package should make it easier for banking groups to manage capital and liquidity across borders within the banking union, while applying strong safeguards to protect financial stability. Alongside our EU bank reform package, we are publishing our analysis on the responses for the call for evidence. It was our public consultation on Europe's regulatory framework for financial services designated to check our rules are working as intended. Our analysis confirms the overall regulatory architecture we put in place following the crisis is sound. but it points to areas where our rules could be improved, made more consistent and forward-looking. It suggests that in the banking sector, as in the banking sector, our financial sector rules could be made more proportionate and risk-sensitive, and could be adjusted to support funding to the wider economy and to reduce administrative burdens while achieving the same regulatory objectives. It also identifies some gaps in our framework. The call for evidence responses have helped shape today's banking proposals. They will help shape future proposals and inform planned reviews of legislation across the board. This is just a snapshot of the comprehensive package we are tabling today. It sits on a broader agenda for a strong banking sector, complemented by deeper capital markets. In this part of a balance, it is part of the balanced approach where risk sharing and risk reduction go hand in hand as we work to complete the banking union. The difference these proposals could make is real. By supporting a stable, diverse and integrated banking sector, they would help ensure banks remain where they should be, at the heart of Europe's economy.